PassivePockets is presented by Equity Trust. Welcome to PassivePockets, the passive real estate investing show, brought to you by Equity Trust. I'm Paul Shannon with Jim Pfeiffer. Today, we're diving into the future of real estate investing, tokenization. Our guest, Larry Kalis from American Digital Realty and Tyler Vinson from REtokens are helping investors access institutional-grade commercial real estate with lower minimums, more liquidity, and greater transparency, all made possible by blockchain. Whether you're skeptical or curious about tokenized assets, this episode breaks it down for the passive investor who already understands real estate but is new to this technology. Let's jump in. Tyler, Larry, welcome to the show.
Thanks for having me.
Great to be here. Thank you.
Larry, let's start with you. Can you briefly tell us a little bit about American Digital Realty? And we'll get to you, Tyler, as well, so we can talk a little bit about the partnership between your firms and REtokens.
Absolutely. Before we dive in, I just wanted to thank you for the invitation for being here. I've actually been a listener, and it's usually on walks in the woods with my dogs, so it's fun to be on the other side of the mic. And looking forward to the conversation and love what you guys are building on PassivePockets here.
Thank you.
So how did I get here? Well, it's a long meandering path. I started getting into real estate when I was in college and got my real estate license. After that, I started going in other directions. I worked in Costa Rica, actually, for a newspaper. Came back and worked for a consulting firm, A.T. Kearney, now known as Kearney. Went back to business school, and out of business school, went to Bank of America, Merrill Lynch in Charlotte. At the time, it was just Bank of America. And worked with private and public companies, as well as private wealth clients, helping manage interest rate and foreign exchange risk. And so I covered the full spectrum while working in capital markets, including commercial real estate firms and REITs. And what was interesting is, as I was working across the investment bank, when we were developing solutions that were integrated, for our clients, I was privy to material non-public information. And so I wasn't allowed to trade any individual stocks, but there was no prohibition on tokens. And so I started to dive deeper into Bitcoin and Ethereum. And I just thought, the whole idea that Satoshi had for a non-sovereign monetary system in a decentralized fashion on the most secure computer network in the world without a trusted intermediary was just incredibly cool, and it blew my mind. And I wanted to look at how I could leverage my traditional finance background into this new digital asset ecosystem. And real estate really felt like a good spot, because we're talking about tangible, hard, scarce assets and with real cash flow. And so I connected with American Digital Realty. We're building an investment platform to make passive real estate investing easier and more efficient and smarter. And we do that by introducing a new type of asset, TRIFs, tokenized real estate investment funds, which are basically a diversified portfolio or sector-specific portfolios of private middle market commercial real estate.
It's fascinating. And Larry, your firm, American Digital Realty, is partnered with Tyler, your firm, REtokens. Tyler, can you give us a little bit of background about REtokens and how you got into this space and how REtokens fits in with ADR?
Yeah, happy to do that. Bear with me for a quick disclaimer that I need to do, that I'm not here to give any tax and legal advice. It's just for educational purposes only, not promoting any particular investments or offerings or anything like that. So with that out of the way, my background is 25 years in real estate investment, everything from private debt to private equity, and then, just the traditional way as well. And that's what really led me into the world of tokenizing real estate. I've always had a vision of wanting to serve many in the world of real estate investment. But that can be really hard. There's high entry barriers to get involved with real estate. There's complex legal structures and all sorts of things. So the combination of what's happened with like the Jobs Act and then how technology integrated with that is really what started to give rise to the ability to make the ownership of real estate digital. And there's an underlying technology called blockchain. No need to deep dive that unless you guys want, but it's kind of like the internet where websites and apps sit on the internet. This new digital asset world that you probably hear about sits on something called blockchain. And I think it's really that simple. But what it does is it opens up a whole lot of additional amenities and strategies to traditional real estate that I think can just get a lot more people involved. So when I understood that, on my side, it was to unlock a lot of trapped equity that I had. And on the other side, it was to be able to service a lot more of my investors or what we call limited partners in the deal. There was just so many bottlenecks to be able to serve that group on a larger scale. And so that's what really led me into founding REtokens.
So I think we're going to dive deep into what is tokenization and all these other things, but and you've both kind of circled around it, but can you talk to us about what problems in traditional private real estate investing are you solving for the limited partners? What are you guys specifically doing? This is going to be a hard concept, at least for me to grasp. So I want to start there. Like, what are you doing that's going to help LPs and why do we need it? And then let's talk about all the details.
We're solving the same traditional problems you see in real estate and private real estate that have been around since inception. And that's the high barriers to entry or exclusivity for access to deals, the illiquidity, the messy reporting with multiple K-1s if you're trying to diversify across various deals. And, then you're also going to have the lack of bandwidth for people to be able to do the due diligence. And so what tokenization does, it allows you, in a sense, to pool capital to be able to enter into some of these deals that may have higher minimums. And so by fractionalizing, in our case, the various GP or funds that we're entering into, we're able to create customized portfolios and sector-specific portfolios by tokenizing the various exposures. And when we say tokenizing, we're just digitizing the physical security certificate, essentially. And by doing so and putting it out on a public blockchain to be recorded immutably, you're enabling liquidity. And when I say liquidity, I'm not saying we're necessarily looking at meme stocks or day trading real estate. We're giving you more liquidity than you otherwise would have in a 5 or 10-year traditional syndication. In our situation, there'll be a 1-year lockup, and afterwards we'll connect up with REtokens to be able to offer secondary liquidity. And, we think that's a benefit better than if you were in a gated redemption type vehicle like a B REIT or an S REIT, because you never know if you can get out the door. At least, in our situation, offering in a secondary market, there could be a clearing price. And so it does provide the potential for that liquidity. The other thing is, a big differentiator for us would be the fact that we're diversifying across multiple different sponsors throughout different sectors as well. We would consolidate that all into one K-1. So you won't be chasing deals and chasing the various tax reporting statements because we'll be able to consolidate that all into one. So the tokenization helps us streamline the operational process for doing so.
Larry, use the term fractionalize, and I want to make sure that our listeners understand really what tokenization is in simple terms. Can you really explain that and define it? And then you talked about liquidity and a secondary market. How does tokenization solve those problems? And how liquid can an asset be that's traditionally illiquid?
Well, I'll talk about tokenization, and then I believe Tyler wrote a book on liquidity, so I'm going to pass that off to him. But as far as tokenization, just to break it down, it's the process of turning ownership of a real-world asset like real estate into a digital representation on a blockchain. And so think of it as a digital wrapper of your LP interest in a property or a fund. And so instead of paper-based records or computer-based records necessarily, you have a programmable token that represents your stake. It can be transferred securely and lives on a transparent, auditable ledger.
This is where I think I'm going to get lost. And so I'm going to assume maybe a few of our audience members might be as well. So let's just break it down to an example. There's a multifamily deal in Florida that I'm investing in, right, with a certain operator. I'm going to put 25 grand into this deal. Now you're going to tokenize it. That means you're going to register my ownership of this what I own, the 0.5% or whatever of this asset, you're going to put on the blockchain so that everyone can see Jim Pfeiffer owns this piece of this deal. Is that kind of what you're talking about?
That is, I mean, you're going to have the same, it's still real estate. At the heart of it, it is still a real estate investment that you will receive cash flow from, hopefully, and appreciation. And it's a digital security and a digital representation of that investment. And by putting it on the blockchain, which is basically just organizing the cap table, but on programmable tokens, it enables you to have that potential liquidity in the future.
Meaning that I can sell it, part of it or all of it, to somebody else, because all I have to do is transfer that tokenized blockchain code or something to somebody else.
Right. It'll be somewhat abstracted. It'll sort of just be done online. We're going to be connected with Tyler, who's a regulated broker dealer, to be able to transact. And so I think Tyler probably could jump into a little bit more detail there.
I mean, I get asked what tokenization is all the time, and I would actually say Larry has got it down well, but I'll just kind of try to build additional context in how I answer it. When you do a syndication, the GP or the sponsor is selling equity, and these are LLC membership units, or people call them shares. Tokenization is simply making that ownership digital. That's it. You're just making that ownership digital. And it opens up the door to a lot of what Larry was talking about. An analogy I give a lot of times is traditional real estate is like a large gold brick, a really large gold brick. So it can be hard to get into and out of, specifically when we're talking about LPs. And then everybody has to do the same thing at the same time. So if the asset's going to sell, everybody sells. If the asset's going to refi, everybody refis. If the asset's going to do nothing, everybody does nothing. But the concept of tokenization takes this really large gold brick and now gives everybody gold coins, right? So they can sell or buy or trade or do nothing on their own, right? So same value of gold, if we're talking about that, but now everybody has their own gold coins instead of having to move around like a gold brick. And to answer your question earlier on the benefits to LPs, that's obviously important. One of them is going to be the access to deals that they may not otherwise have access to. When you create a marketplace where people can go to and that has all of the information forward facing as compliant deals need to have, they're going to have a lot of options for diversification and a very easy way to invest in those deals. So access is one. And like Larry mentioned, typically those are going to have smaller minimums for kind of the third bullet point I'll make. But the second bullet point is the future of real estate ideally trades like stocks or more recently crypto. Real estate has not had that ability. As Larry said, it's traditionally an illiquid asset. And other asset classes have benefited from this digital era that we've had, but real estate's really been left behind. And that's exactly what we're looking to trade. So when you have that digital ownership, just like a Reg D is an exemption to registration when you do a security, when you do a resell, and now we're talking about involving non-accredited investors as well, you also need an exemption, and that's called Rule 144. So if Reg D is the exemption for a primary raise or a capital raise, Rule 144 is the exemption for resale. And so with that digital ownership component, once we approve a deal, like in this example, we're talking about American Digital Realty, and Larry was mentioning potentially listing on the secondary market after 12 months, which is one of those rules under 144. We would do our due diligence on that deal to make sure compliance and everything like that is in place. And then we would list it on our secondary marketplace where investors, including non-accredited investors under 144 as mentioned, can come and review deals like that and invest right there online. And so that's a whole nother level of diversification and access that investors have never had, and actually gives them the ability to not be locked into a deal for 3 years, 5 years, 10 years, sometimes 20 years or forever, right? Now, under that particular exemption, in this example we're talking about, after 12 months, they could actually sell those to another investor. And those investors just have to go through a process known as KYC, know your customer. So we've got the identity verified. Anyway, the third piece of that is when you do all of this, the point of making it digital and the reason you haven't had a secondary marketplace and some of these things before is it's so cumbersome to trade a private share of real estate, an LLC membership share or share. It's doable under the law because obviously we're functioning under current law and SEC rules, et cetera. But there's no mechanism. There's been no vehicle to do that. And so that's what we've built from a technology standpoint is a vehicle that has compliance as utmost important and allows this what we call a Web3 kind of back end where I'll geek out for just a second. You got a transfer agent, custodian, an ATS matching agent. You got all these things that you really don't need to know too much about operating in the back, right? But the user experience for the LP, for example, if they were going to invest in a deal like that, is very much a Web2 experience. Like think of online banking or some of the current investment platforms that are out there. That's really the experience from the user. So it really streamlines everything for everybody. And that's, like Larry mentioned, lower minimums. And there's all sorts of efficiencies now that we have this digital ownership that's built in there. And then, the blockchain, I think before we hit air, we were talking about blockchain a little bit. I think it's just a misnomer. People get so caught up in the technology because like Larry said, underneath, it's just real estate. This is just fundamentally real estate. You need a great operator. You need the regular rents, the financials, et cetera. But now we're just adding amenities to it. So yes, we reference the information off the blockchain, but you don't need to know what that is. It's kind of like these cell phones that we all use, right? I could sit here and say, well, it sends a signal to space and then it does something with a satellite and come, right? Or I could just say, actually, I can speak live to somebody on the other side of the world right now with just a couple clicks of the button. So that's kind of my blockchain analogy. Don't get too caught up on that. And tokenization is simply just adding a digital ownership component. But when you add that efficiency of the technology and the marketplace that we've built, it makes for a very seamless experience for the LP.
So regarding the marketplace, Tyler, I want to make sure I understand, and I'm not confused here on the relationship between ADR and REtokens. Am I correct in saying ADR is akin to like Bitcoin, Ethereum, Litecoin, the actual modalities that are traded on an exchange, and REtokens is the exchange itself, similar to like a Coinbase or a Binance, where you can actually have a marketplace period where goods are brought and traded, essentially. Is that correct?
I think probably from a high level it is. I'll let Larry speak to the specific of his product that they've got because we look at it through a more of a real estate lens than a crypto lens there. Although, as mentioned, these real world assets, like of what they're doing, has some of the benefits. And yes, you can look at REtokens as a NASDAQ private markets or a Coinbase, a marketplace that people can buy, sell, and trade private shares of real estate, which we're really excited about because it's just not out there right now. And it's long overdue for our industry and for investors to be able to really take control of their investments, take them to the next level.
So how on the marketplace, how is the price determined after the initial offering is set? And maybe there's an investor that wants to sell on the secondary market 2 years after they got into the deal. They know it's going to be a longer hold. Things have changed. They want to sell. Is there a bid and an ask similar to like you'd find on any exchange in any asset that's traded, online, or is there some other process that is there actually human contact where people have to discuss and negotiate? How does that work?
Yeah, so I'll kind of try to slow this down and unpack it a little bit. And you mentioned a bid and an ask, and we've been talking about marketplaces like Coinbase and NASDAQ, et cetera. When you buy and sell an asset on those marketplaces, you're actually not interacting with another buyer or another seller. There's something in the middle called a market maker in the crypto world, liquidity pools and things like that. And that's what provides kind of that instant liquidity. And it also provides price stability and some things that you see in more mature marketplaces. Right now, as we launch this in 2025, we don't have a market maker in the middle. So let me come back to that, because hopefully about a year from now or sometime in 2026, that's changed. We're having those conversations right now because we feel like it's an important part of the ecosystem. But right now, you are actually going to transact seller to buyer and so forth. And that's the technology we've kind of built in to the back end. So I'll need to just speak from the broker dealer standpoint, and then Larry can talk to how they may value their asset. And if we're talking about the secondary marketplace, when we do a due diligence, we're going to take a look at that, make sure the deal is compliant and verify all the information that they have moving forward. We're also going to take a look at the viability of the pricing. Real estate is unique, right? Because you can pin these values down based on net operating incomes, based on appraisals, based on third-party validations, all sorts of things in a little bit different way than, say, like a startup or something like that may be more speculative. And so we allow the issuer to choose that price on the secondary marketplace. Once the project's listed, right, then whoever owns those real estate tokens, those ownership shares, can go list those for whatever they want. Right? That's a high level thing. There could be some more customization involved in that, but for now, we'll just say that that's what they're listing them for. And then the buyer goes on to a marketplace like REtokens Capital secondary market, and they can see what assets are listed for sale there and how much, and they could get in and see, for example, what type of cash on cash return might be moving forward, if there's an IRR or pro forma projections, just like real estate is done today, right? When somebody makes a decision on their investment. And so that's really how we look at it and see it. So it's going to be very much a buyer and seller. The market will need to figure out what that price is. And then in the future, it will function more closely to some of the traditional marketplaces you see today, where there's either a market maker, a liquidity pool, or both. There could be a couple ways to do that. And typically there is a bid and an ask at that point in time. And the whole goal for the market maker, the whole reason there is just to create a lot of that, instant settlement. So when you list on the marketplace today, you're depending on a buyer on the other side to, buy that security. And same, we are seeing a lot of pent up demand for these tokenized real estate projects, but they've got to be on chain for somebody to be able to buy, or they need to be in the marketplace for somebody to be able to buy. So it's very early innings as far as that goes. And like Larry said, what's happening here, though, is we've created a pathway for potential liquidity. We've started to, do this ecosystem. And as there's more participants in the marketplace, and we just got back from an event from Dallas, there's a lot of people wanting to get into this marketplace because it's long overdue. But as that happens, there'll just be a more robust environment. And I think that over time here, you will see settlement and liquidity and those things increase in the space.
It's an excellent question, because it can be difficult to determine what the exact price is, just like it is with REITs. And sometimes they're going to trade above book value or below book value. So in our situation at American Digital Realty, we're sort of working on a fund-of-fund structure. So we're partnering with top-tier GPs across sectors, geographies, and strategies. And so we're going to start off with a diversified TRIF, tokenized real estate investment fund, that we are going to be somewhat dependent upon our partners for their valuations. And so, it's not going to move daily. If we got them quarterly, at least we can determine what book value is. So NAV would be a guidepost, but ultimately the market is going to set the price.
So let me back up a little bit. Again, I'm just trying to comprehend this because it's super simple and also very complicated at the same time, seemingly. So if I'm talking about RE tokens, in theory, I have 5 syndication deals that I'm already owner, the normal way, just as a normal LP. I could maybe go to RE tokens and say, hey, I'd like to sell these. I want to put them on your platform. And you could match me with a potential buyer and we would negotiate a price. Is that kind of what RE tokens? And then I want to get to what ADR does, because it seems like ADR is more like a mutual fund where you pick what goes in there. ADR picks what, the individual assets are, and then you just host it on RE tokens. Am I close on any of that?
I think you're close, but what we would need to do, let's again just use American Digital Realty as an example for conversation here. We are going to take what they're doing, and we as a broker dealer are going to do due diligence on that. One of his LPs and his fund is not going to be able to just come straight across. I mean, they could potentially come straight across and list, but they're going to need all of the information that we need to do the due diligence and make sure the deal is compliant for the platform. So it's not likely to happen that way. Plus, there's a cost to do that. And so what's far more likely to happen is, somebody like Larry will want to list his project on the marketplace. We will do due diligence, verify that all of the information is being put forward, the docs are compliant, so on and so forth. Because remember, on this secondary marketplace under 144, you can sell to non-accredited, right? If it was a 506C accredited only, now after 12 months, like Larry said earlier, you can actually access and you can trade shareholder to shareholder. But that's how that beginning part works, Jim, is we're going to do the due diligence. Now, once we have approved that deal, then yes, the LPs or whoever wants to in that deal can come list their tokens on the ATS exchange, assuming it's set up that way. I mean, Larry could customize that further if he wanted to, but in high level, that's exactly the way it would be. If you were an investor in his deal and he got it approved for the marketplace, then you would be able to come list your real estate tokens on that marketplace.
Okay, so it's not a place where I can, all of the deals that I've been doing for the last 10 years, I can't bring those up. It's not a secondary market for me. It's you are dealing with operators as they're setting up their deals. They're putting their deals on your platform, and then it becomes, if I'm an investor in that deal and I decide I want out for whatever reason several years down the road, that's the secondary market, is where I have options as an investor in the fund. Is that accurate?
Well, we actually want to target all the current seasoned Reg Ds that are out there that have 12 months because they can trade in the secondary marketplace today. So no, as you know, there's hundreds, really probably trillions of Reg Ds or private placement type vehicles out there that are securities that are more than 12 months old. They can come right now and get listed on the secondary marketplace.
So it's GPs that you're talking to, not LPs, right? The GPs need to bring the deals and put them on there, and then the LPs can trade from there.
I think that's the best way to look at it for right now. Yeah.
Okay.
So you're stuck, Jim. If you got capital calls on anything right now, you're stuck with those.
Right.
But going forward, if you invest in tokenized deals, or if a GP goes ahead and decides to tokenize an existing deal, there is the potential to exit. Just to bring you up to speed a little bit. I mean, probably the first successful tokenization project in real estate was the Aspen Coin back in 2018. And that was the St. Regis Resort selling off a portion of the hotel. And with that, I think that was sold at $1 a share. I believe it's trading about $3 a share right now. So it actually has been pretty successful. There's not a ton of liquidity. I don't think a lot of people are buying and selling right now. And then there became a big lull in the market for a while. And I think there was the thought that there was going to be more momentum. And we just didn't see that. And you guys are obviously familiar with what happened with rates rising in 22 and 23. And that hurt real estate, across the board, including the tokenization market. But what we've been seeing lately is real institutional adoption within the space, and particularly from some of the private credit firms. And so when you look, you see Apollo has tokenized one of their private credit funds. KKR has also done one of their private equity funds. You see Fidelity, or you see BlackRock, for instance, doing BIDL which is a money market fund. And so, mainly those are used for native crypto folks who are on chain and don't want to have to take their money off chain into what we call fiat and then move it back. And so they're giving tools for them to invest. And, that's part of the whole drive towards real world assets and tokenization. And probably the biggest one, the biggest tokenized marketplace is stablecoins. And the Genius Act just passed in Congress, giving regulatory clarity to stablecoins. And so you see a bunch of different players, including the traditional banks, getting involved, in Circle as well with USDC. And that's just basically a digital representation of a dollar on chain. And what we're doing here is a digital representation of real estate on chain, to make it more efficient. But you still have at it, like I said before, at its core, you're making a real estate investment. You're just getting a little bit more value from your real estate investment because you have more flexibility. In the case of American Digital Realty, our goal is to be the vanguard of private real estate. In a sense, create an ETF-like user experience or investor experience, because we are partnering with these various general partners and operators in multifamily, industrial, manufactured housing, lending, and we're going to go ahead and take all of those various positions, put them into individual sector TRIFs, and they will all flow up into the diversified TRIF. That diversified TRIF is akin to the SPY, the S&P 500 index. And so if you want a really diversified portfolio across all those sectors, you could do so with the diversified TRIF. Or if you want to get some type of custom portfolio, you can invest in the individual sector TRIFs, which is, the ETF-like feel that we're trying to get. It's a little bit different than what most are doing, I think, with tokenized real estate, in that they are tokenizing individual properties. So recently, MUFG, the Japanese bank, is tokenizing, or they've announced that they're tokenizing a $600 million building. And you're seeing that picking up throughout. And that's why folks like Deloitte or Citi expect that the tokenized real estate landscape will hit $1.5 trillion by 2030, 35. I can't remember the exact date. So that's just a little background on tokenization. Yeah.
I think that's fascinating. There's a ton of value there. So to build off that, I have an additional question that may be simplistic, but let's say I'm a limited partner. Larry, I want to invest in the diversified TREAT. I get a token that shows my fractional share of the LLC that owns the underlying real estate.
That's right.
When that real estate kicks off cash flow or is paying preferred returns, et cetera, how am I being paid? I understand that I have a position that shows my ownership stake, and if it sells, I will get my principal and any appreciation, hopefully. But during the hold period, if there's any cash flow, am I getting paid in additional tokens? Am I getting a check in the mail? How am I compensated during that time period?
It's total pass-through economics. It's just a regular Reg D 506C fund. And so not only are you going to be passed through the cash flow, but you're also going to be passed through the depreciation. And with the one big beautiful bill, it's a lot more depreciation. And so the way we're structuring our fund, we're going to have some mezzanine debt and some senior debt and some preferred as well as some common. We're spanning the entire capital stack. And so we're able to get a pretty decent cash flow right off the get-go, right off the bat, while we wait for some type of appreciation for the opportunistic and value add. We're not really doing much development. We're not playing much in office and retail right now. So we made some decisions, somewhat conservative on our portfolio allocation. But you would get the cash flow and you would get your K-1. And the beauty of it is, I heard your guys' episode with Scott, and you guys were talking about FIRE, and I think there was a discussion about active versus passive investing. And ours is bringing passivity back to passive investing, because you don't even need to chase the deals. We're going to curate the portfolio for you, and then we're going to consolidate the K-1. And so you can go, put on the TV and throw on Netflix, sit on the couch and eat a sandwich and collect, the cash flow that's coming from it rather than chasing the deals. The other thing is, by pooling our money with our investors, we're able to get assets that we wouldn't otherwise be able to. So minimums that are much higher in the 250 range, 200 range. And so really getting access that family offices and high net worth investors generally do. And we're able to do this at a much lower price point for our investors. And so that's the idea with the benefits for what we're doing.
But to enjoy that FIRE lifestyle, you actually have to be able to have cash to spend. And I can't use an ADR token at the grocery store or at the movie theater. So is that what I'm getting paid in, as a token that then I go onto REtokens to exchange into cash on the exchange? Or is it you're actually sending me a check in the mail?
Either way, we can do it through USDC, a stablecoin. Fiat is fine. We still like regular dollars, even though every single day they're devaluing. So is USDC, though, because it's pegged by the dollar. But you can really abstract the fact that it's tokenized if you want to, and go online and pay in dollars, receive in dollars. It can go into your bank account. It can go back into the ADR platform. You can pour that, because this is our first fund and we want to have a series of funds, maybe you want to go ahead and move that money into an income fund. So we would have, multiple GPs involved in our income funds and our partners. And, we're working with top tier sponsors. And so we have the benefit of starting right now, coming out of a difficult time within real estate. And we're only working with ones that, mainly didn't have capital calls, weathered the storm, have conservative underwriting, generally taking long-term fixed rate financing, and not over leverage. We've put what I call the dream team of various sponsors within their niches, within their sectors, and bringing them all together into one fund.
I'm slowly understanding this, I think, but how does a deal get into your fund? Let's say, do you go to the operator and invest in one of their deals and then it's in your fund and then LPs can come and invest in your fund? Or do I, as an LP, invest in the deal that then is in your fund? I'm not sure I understand how you get a deal into ADR's fund.
That's an excellent question, because usually with allocators, the way it's done is that they're representing that they are selling a particular investment, but you're actually going right to that GP. In our situation, American Digital Realty is taking LP interests and other GP deals, and we are then going to take the amalgamation of all those LP interests, and we're going to tokenize that to create our fund. And so you as an LP would only be investing in one fund. One token, you would purchase one token, would give you diversification across sectors, sponsors, geographies, strategies, and the capital stack. And so that's what you're getting from us. So it's really, you would be signing on to ours just like you would be signing on to any other LP deal. The difference is we're going to give you a diversified portfolio.
So how do you get the capital to start up? Because, you have to invest in multiple different deals. If you're taking the LP positions, you have to have a pretty big stack of capital to get that started, right?
Well, you do and you don't. We're cobbling together some of our own money and friends and family money to get us off the ground here. And then, we've negotiated terms with various sponsors, at higher share classes than we otherwise would from where we're starting, with the expectation that will be a good source of capital on an ongoing basis. And, working with funds is a bit easier because the timing issue is not that big a deal, so that we can continually, as we increase our capital, we can flow more funds into different funds, and we could change our allocation as well. And so that's a big difference with REITs, for instance. They are buying full properties. We're just buying small shares and other folks' properties. And if that isn't doing well, we'll shift new capital into other deals or other sectors. And so we can be very nimble with our strategy. But as we get going here, it'll be slow. As we accumulate capital, we'll actually have access to some deals that we aren't able to right now.
Larry, you touched on some things that were related to risk in traditional syndications, like fixed rate debt, for example, or conservative underwriting, to use some of the phrases that you used. And that's music to my ears. That's what I think about before I think about returns. But when we talk about tokenization and really this whole conversation of changing the way real estate is traded and acquired, what additional risks should LPs be thinking about when they invest here versus just the deal metrics and the operator itself of the deal?
Well, with tokenization, you're really dealing with the technology. Okay. And so you want to make sure that you're going to be working with a secure blockchain. And in our situation, we work with the Stellar blockchain, which is really an institutional grade provider. They are purpose built for financial transactions. And they have the likes of Franklin Templeton and some of the larger institutions. And so we have a very secure blockchain and a very good tech partner in Block Time Financial, some Wall Street folks who are now entering the digital asset space as well. And they're the ones that developed our tokenization platform and our investor portal. So, which is also a little different than what a lot of others are doing. We have our own tokenization platform. And so we feel pretty secure. The data is encrypted. No one can see who you are when a transaction is on chain, but it is a transparent ledger, basically a shared spreadsheet that provides auditability. So in a sense, I think that gives you more security with the ability to audit the, what I would call paper trail, but I guess it would be the token trail. This isn't like a situation where you're going to see a big crypto hack, because we're working sort of in a walled garden where you have to do anti-money laundering, know your customer, and sign up on our site. So if there was a lost token, we could burn that token and mint another token. So we have security measures in place that should make people feel comfortable that there shouldn't be an issue working with this new technology.
I guess my maybe last question is just kind of similar to Paul's. Like, how do I store these tokens? Is it like Bitcoin where I have to like have all kinds of anxiety that I'm going to lose my codes? And in terms, I mean, you just said you could burn one and produce one, so maybe not. So I'd like you to answer that. But other than that, at PassivePockets, we typically vet the operator of each deal or fund that we're investing in. And we put a lot of time and energy. That's the non-passive part of this, is we really dig in and try to get to know the operator. And that's one of the things that I like about this type of investing. If I was to invest in Apple, I'm not going to be able to call up Tim Cook and ask him how things are going. But when I invest in a syndication, I can. And then we look at the deal separately and analyze each deal. So if you are putting all these GPs together and then picking the deals, it makes it much more passive. But how does an LP look at this as far as how am I vetting the operator and analyzing the deal? Am I just vetting ADR and putting all of my trust that you are making the correct decisions? And that's fine if it is, because this is like investing in a mutual fund, right? Where you're not maybe analyzing every stock. So is that what we're looking at? Or how does an LP analyze and determine if I want to get into this fund? That's my question. And then how do I store it is the secondary question.
Yeah, let's start with the secondary question. We custody it on our platform, so you don't have to worry about losing your keys. Tyler can talk a little bit about custody as well for the exchange. To a certain extent, you are putting a bit of faith in American Digital Realty, and that our team, our advisory team, and our consultants within the real estate space are making good decisions. But you have some wonderful guests on your show, and some of them are going to be our partners as well. And so you have vetted some of them. I'm sure I've heard one of them on Deal Friday before. And I was happy to hear that it was a positive experience, because otherwise I may have switched a GP in that situation. So we're, looking at, all the deals, and we're looking at, I joke with my colleagues, I don't know if it's 5 or 6 R's, but there's a lot of R's. We're looking at, usually we're getting our best deals from referrals. But then, we're going to go ahead and we're going to look at their reputation, and then the what type of relationship we can have, because we're looking for long-term relationships here that we can have with these sponsors, not one-off deals. And then evaluating the risk and the return and the track record. So we really are doing the due diligence. So hopefully you don't have to. And I understand that is to a certain extent, it feels like you're giving that up to another team, but it is like an ETF or a mutual fund where we're creating these thematic portfolios. And I'm happy to tell people, we give information about each investment within the portfolio, and I'm happy to share with people who some of those sponsors are, because I just don't think someone could diversify and mimic what we are doing with less than $1 million. And so you can go into our investment for $50,000 and get access to hundreds of properties across sectors and across the capital stack. And that's just that one allocation. To be able to mimic working with these same amount of sponsors and properties and get some of those terms, you'd be, like I said, probably have to invest over $1 million to do so. All good questions, and hopefully I was able to answer it.
So when I was talking about that, back end Web3 infrastructure, recall I mentioned custodians, transfer agents, custodians, ATS. So just like when you invest on any platform, if you're an LP, whether that's Charles Schwab, Coinbase, you name it, you have to create an account, right? They need to verify who you are and make sure you're not, a terrorist and things like that, right? And so when that's done, on our platform, they create a custody account as well. And in fact, it's a multi-asset custody account. So I won't get into it, but you can hold various things in there. And so when a group like Larry's, they put their asset on our platform, they also have a custody account. So this back end and a transfer agent's integrated, all these technical pieces are integrated. So when two parties want to make a trade, everything's verified that they have the asset, they have their asset. We know what the cap table is, their source of truth, there's everything. And boom, it transacts on the back end. So they have these accounts already. And then from your account, again, just like any other exchange or platform, it can go right into your local bank account if you would like, right? And so they're able to hold custody in these accounts. We automatically have a custody account for them. Everybody who transacts on the platform has a custody account there. And the custody accounts are also from a SEC registered custodian that we work with. And yeah, what Larry said is true. These are securities. It's not crypto where if you lose your keys, you're in big trouble. These are securities. So there's live cap tables, who owns what, and you can burn tokens and reissue them. In regards to vetting deals, so many layers, right? And as Larry mentioned, they did do their due diligence. On a platform like ours, we're an SEC registered broker dealer. Our job is to verify all the due diligence and make sure that what they're saying is accurate to the best of our ability to research, like who's the sponsors, what regulation exemption, are they compliant on that regulation exemption, are they putting forth the financials that are required for a compliant listing. All of these verifications is a big part of what we do. So there's a huge benefit to a company like Larry's when they list on a platform like ours, because we're an SEC registered platform that's done the due diligence on that deal. And that, typically adds another layer of, confidence. For example, I'm going to use the world of crypto since there's it's missing a lot of confidence. The go-to place typically in the crypto world in the United States is Coinbase, because they're a public marketplace that obviously needs to be compliant under what they are. Now, crypto is different than the type of marketplace that we are as a SEC registered broker dealer, but the principle is the same, that there's regulatory significance, major significance here that is much different than your typical back of the napkin deal at a bar, or somebody that holds their cap table on an Excel spreadsheet on their computer and you're just hoping and trusting, them. So when you're talking about what Larry was, you're looking at multiple due diligence, probably the sponsor themselves. And as they mentioned, they're choosing great ones there. They do their own level of due diligence. But before it gets onto a marketplace like ours, we're doing broker-dealer deep dive due diligence with chief compliance officers and things like that to make sure that those are all properly in place.
Excellent. Well, guys, this has been really fascinating. It sounds like this type of investing is kind of the future, but I think we're always going to be investing in individual syndication deals or individual funds. This is similar to, you might have a part of your portfolio in mutual funds or ETFs. That's the same here. It's a great way to get some diversification and have a chunk of your cash in something that's this broad. So we really appreciate you guys coming on here and sharing. If you could both kind of tell us if someone's interested in learning more or they want to get started in this type of investing, can you guys tell us where to find each of you and how to take next steps if people are interested?
Sure. One thing I just want to distinguish, American Digital Realty is somewhat unique in that we're doing a portfolio style investing, while I think a lot of the folks that are going to be listing with Tyler will be individual properties. But I think what you said makes a lot of sense, because you could go ahead and anchor your portfolio with a diversified TRIF, tokenized real estate investment fund, while then buying individual properties as well. I mean, initially, when we were looking at American Digital Realty, we were going to be buying individual property tokens and making these funds. But what we found is that there wasn't the type of properties available that we wanted to build the funds. And we realized we were going to have to tokenize our own properties and funds, which is what we are in the midst of doing right now. And so I'll leave you with this. I mean, the as far as the momentum in the market, the SEC chair, Paul Atkins, recently said, if it can be tokenized, it will be tokenized. And so that's why you're seeing places like Robinhood tokenizing stocks, which are a lot different than what we're doing, because those are mirrors of stocks, and they don't give you the legal rights that the stocks do. This is different. In this case, we are tokenizing real estate, and it does give you the legal right to the real estate or the LP interest. So you can reach us at www.americandigitalrealty.com to learn more. We're not ready to launch at the moment, but we should be shortly. So if you sign up and join the community, we can go ahead and keep you updated and let you know when we're going to be out the door. If you want to learn more about real estate tokenization, please be sure to join the godfather of real estate tokenization, Michael Flight, who's on our advisory committee for the Real Estate Blockchain Summit in September.
Yeah, and for REtokens, you can just go to retokens.com. We've got some information there. The secondary marketplace will be launching in Q3 of this year, but we do the broker-dealer. REtokens Capital is our broker-dealer, has primary as well. REtokens has a YouTube channel, just at REtokens. We've got some great general information there. And if you want to hear some thought leadership on how we're approaching things, then we also have a page on LinkedIn.
Excellent. Well, thank you so much, guys. This was just fascinating, and thank you for your explanations. I know it took me a little bit longer to kind of click in and understand what we were talking about, but this is great stuff. So thank you very much.
Thank you both.
Yeah, really appreciate the invitation. It's been good talking with you guys today.
Yeah, thanks for having me.
Tokenization is no longer just theory. It's already changing how some passive investors can access private real estate. Thanks to Larry Kalis and Tyler Vinson for helping us understand how blockchain can unlock new opportunities without compromising on yield, tax benefits, or diversification. As always, like, subscribe, and check out PassivePockets.com to join our investor community with a 7-day free trial. Thanks for tuning in, and happy investing.